Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Sean Tagge. He began investing in real estate in 2017 and was involved in over 1,500 single-family real estate transactions before transitioning to multifamily investing. His team has since acquired 9 multifamily apartment complexes, totaling over 1,300 doors, while raising $50 million from limited partner investors. So thanks so much for coming on today, Sean.
Yeah, hey Charles, thanks so much for having me on. It's great to be on with you, and yeah, I look forward to diving into whatever we find.
Fantastic. That sounds great. That's how we do it on the show. So before we get invested really into what you're doing now and what your team's up, can you tell us a little bit about yourself, both personally and professionally, of what you did before getting started in real estate?
Yeah, sure. Went to the University of Utah, did biomedical engineering, bachelor's of science, then worked at a hospital under some physicians doing artificial heart research and quality control. Did that for about 3 years, and while I was doing it, I bought a duplex, and that what really shot me off to getting into real estate. So that's when I started and quit my full-time job and dove full time into flipping houses and getting some rentals.
Why did you choose real estate as your investment vehicle back then?
So yeah, I mean, I was just young, and of course, everyone tells you, well, at least where I grew up, it's better to own than to rent, right? Like rent is basically throwing your money in the trash. Where if you own something, yeah, a little bit goes to interest, but you build equity, you pay down the mortgage. So I always wanted to own a house, and once I got a job, could qualify. I just figured that was a great way to start. But then what flipped the switch for me was when I saw a listing with like a mother-in-law apartment. And the realtor told me like, yeah, you can just rent this out, $1,000 a month. I was like, oh my gosh. So then I started only looking for duplexes to fourplexes, right? Because, the 4 unit thing. And I just mathed it out like an engineer, spreadsheet it out. I'm like, wow, this thing will pay for itself. And I just want to do real estate. And I saw it was way better than what I was getting in the stock market and, in the S&P 500. So it just flipped the switch completely.
Before we get into kind of what you're doing today, can you briefly explain how you guys completed 1,500 single-family transactions? Because when you hear a company doing this many transactions, I mean, it really shows that you guys had like an actual team and system to facilitate those properties. So can you give us like a little background to what your team looked like at that point and what your role in the firm was to propel you guys to do that many transactions in such a short period of time?
Yeah, so quit my engineering job in 2017, and that's I've already before set it up. That's where I met my future partners in Memphis. So from Salt Lake to Memphis, and they were already doing pretty good on the flipping end. Already had a decent company. Like their dad is a father-son duo. The dad already had a lot of rentals. They were just so busy, right? In 17, the market was going nuts, bonkers, and even more years later. So there's like, we need someone organized, an engineer, and like if you're hungry and ready to do this, which I was talking to people about, I want to get out of engineering and do real estate. They're like, let's have you come over here. Flew over and struck a deal. And so yeah, then I got 2 years later, was made partner, and we were doing around 200 to 300. I think we did like 322 was the most in 1 year, single family flips. Obviously, like we had 3 partners, so Jim, Brad, Mark, and then me. And yeah, like you said, it's an operation. Like, I don't know if a one-man band could handle it. If he did, he'd have a lot of C-suite people. But yeah, I mean, we had 3 renovation managers. They each had like 5 to 10 different paint crews and, plumber, different than a plumber, electrician, they had all the subs underneath them to renovate a house. And then we had in the heyday 21, when we're at full cycle doing 322 in that year, we had, three acquisition managers, 2 acquisition assistants, 7 virtual assistants, an office manager, contract manager, 2 sales manager, of course, our partners. What else? 2 marketing guys,
Transaction managers and stuff?
yeah, and like 2 or 3 bookkeepers.
Jeez,
Yeah, it
yeah.
was a fully loaded machine. We were prepped to do 400 deals a year. Obviously, interest rates let us know otherwise, the Fed. But yeah, we were getting primed up to get up into that zone, and we use traction. So a lot of organization, systems, process, stats, data, because you got to be tracking and have data and like weekly knowing where you're at on everything. So we were watching things pretty decently, and things were changing way rapidly from 20 to 21, 22, 23. So yeah, it was crazy.
That's one thing I find between kind of real businesses and then people maybe that have lifestyle business people is tracking the numbers. Like and you can do it. It's much easier on a smaller scale, obviously, when you start, and it can be very straightforward and very doesn't have to be as much detailed. But that's one difference I've seen when I speak to much more accomplished business owners that actually have businesses, not just like high paying jobs, is the tracking of the numbers and knowing the numbers. And I mean, when people start throwing that out when you're talking to them in conversation, you're like, well, wow, they've tracked it. They're like, it's a whole different level than someone's like, oh, we do this and we do that for marketing, and the schedule and the appointments are filled up, so everything's fine.
Yeah, I mean, we had, every dollar of marketing in each different like billboards, direct mail, website, SEO, PPC, this and that. We knew what we're spending each month, what we're getting returns on, how many leads, from the top down to the bottom, on the reno, weekly, the bills were coming in, our budget's 25, we're halfway through the reno. Are we at 12,500 on the reno? Our average time to flip a house was 95 to 120 days. So 3 to 4 months, we were turning these out. There's this small, turnkey properties. So they're just single family, 3 bedroom, 2 baths, 1,200 square feet was our bread and butter. It came down to that, and then had a map, right? Where, this zip code makes us a better profitability. This one has a higher loss percentage. So maybe we need to, or less profit margin. So maybe we need to offer a little bit less and have a better profit margin in this zip code. Like that's where we're starting to get down to. Obviously, this didn't happen at the beginning. We really we're lucky to know what we were making at the end of the month. So we started just fully onboarding all that stuff, all those numbers and data, which I played a big part of as the COO. But then it became nice because eventually the division leaders kind of were handling those numbers, and the virtual assistants were helping. It's a lot of data entry and gathering, which is nice to have a virtual assistant, $10 an hour or less, just typing in a lot of numbers. And then it helps you though, as a leader and your other guys, to be aware of where you're at weekly. And so we'd have weekly reports going out, just flagging items, if it's in this zone, it's brought up to our attention, things like that.
Yeah, we have for KPIs for our company, and it's one of those things that, assistant takes care of it. I would never want to do that, but it's you have to kind of set it up initially and explain exactly how you want to do it, and then it's something that everybody has access to it, and it really shows you, down to cost per lead, cost per whatever acquisition, and you really know where you should be putting more money, and then you can really turn it up.
I would say the power to that too is keeping your data for years. So I kept everything before, like we didn't know historical. So but it's amazing when you have 5 years of, how a zip code's performing for an acquisition marketing, or perhaps a renovation guy versus another. Like it really, you see some interesting trends, and it lets you know norms in the market and so that's what's kind of interesting too. So I couldn't imagine these decades long companies like having, 3 to 5 years probably is far back as you really want to trend to, but it is cool seeing, a few years back. It helps you understand a lot of what's going on.
It allows you also to transition in and out of different marketing channels, especially if you're doing direct mail. I mean, you have tons of different pieces that are going out, and you can really track it. We've done it before with a different business I had, and then also when we're looking for smaller, multifamily that we're taking down ourselves, or in small JVs here in Florida. And you really know exactly what your return on that is. And you're like, okay. And then once you hit one, then you're like, all right, this is like a double down type piece. You know what I mean? And that's really important.
Yeah, it's kind of like gambling too, right? You're like, sometimes we'll do marketing and we don't see returns for 6 months. We don't get a single deal, right? But then all of a sudden we'll hit a grand slam deal out of some random marketing channel. So it's like, another thing is just, let it fruition for a year. You got to try something out. That's another point that I kind of noticed.
So let's talk about you guys moving from single family into multifamily. I mean, when you did that, because this is something that I think a lot of investors that have started in the single family kind of realm, whether they're flipping or long-term rentals or whatever it might be, and they would like to graduate into multifamily properties. What were some of the challenges that you faced during that transition?
Yeah. So, trading the greenhouses for the red hotels, right? Monopoly. And, it's pretty natural. Like the reno was easy, renovating 100 units. It's easy because we already have the crews. The big picture is we ran out of our own capital, right? Like there's only so much, and single family, it's kind of easy because you can just get hard money loans and they'll loan you up, almost all the way for that. So on the multifamily though, you need that 20 to 30% equity for the purchase and reno. And yeah, after you start doing, a couple hundred units every year. So the equity portion, it was definitely nerve wracking, just, bringing on investors. We did one deal ourselves, 100 unit, and wanted to just make the mistakes and learn everything on our own. Didn't make any drastic mistakes, just learned a lot. Right. And learned that. So played with our own money first. Then we felt like, kind of the stewardship duty to, and doing all the single families that we could bring on investors. So yeah, just finding the right attorney. I mean, I got myself in the weeds a bit on, 506C and B offering all the legal work, but I mean, it really is, you just pay a guy 15 to 25 grand and he lets you know everything you need to do. It's just before you pull that trigger and pay that money, like you just don't know what's going on until they have. So a bit of a leap of faith. And then raising the money, was a little bit easier because a lot of our people that already bought a single family from us as a rental turnkey, they were with us. Then, not too much like difficulty after those little hurdles.
Nice. So in today's, what does your current company's investment criteria and strategy look like? What are you looking, markets are you guys going to? What type of properties are you guys buying?
Yeah, great question. So I've shifted. I was with one partnership and now I'm with another. And the one thing is just, vision, and I guess kind of age as well. So my other partnership, 165, he has different goals than a 35-year-old, right? I mean, it's just natural, and different like aggressiveness and things like that. And so the new partnership, we're all kind of around the same age, in the same, phase of life, young kids and all that. And, we're in the phase where we're ready to grow and not wind things down quite as much. So that's kind of one, is just, have that vision and culture. And factors in there. Then the next thing is the first 5 deals I did, they were heavy value add, meaning super distressed, super deferred capex and maintenance. I'm talking they were like probably close to being condemned. Maybe not. They're like 50% occupied or less, give or take, on most of them. And rents were $300 or $400 below market due to just the distressedness. So I mean, you bought them super cheap. It's a great flip, great on paper, but you take on a lot more risk of just unknown of sewer, plumbing, asphalt, roofing, like just everything. The railings, the metal railings. So those heavy ad where they're 25,000 a door plus on the reno, and this is for something that's $800 a month rent after you renovate it. It was great. It worked out well. And it was great because also, we bought them like through that COVID phase. So rents went up a ton. It's just a lot more work, a lot more unpredictability. So now I've kind of shifted to more, that's more like the C minus class, getting it up to maybe a C plus. Now we're kind of at buying stuff, a little lighter. It's already 90% occupied, already can get the Fannie Freddie loans, where the other ones, you have them on bridge loans, right? You got 2 or 3 years. That's a short time frame in the grand scheme of things, to where you have to refinance or sell at that point. So these ones we get on 5-7 year loans, Fannie Freddie. So our strategy is more moving towards the B minus, make it a B plus type of asset. Rents are more 1,200 a month. So a little bit different tenant base as well in managing and all of that. It's still in the blue collar zone. Just you kind of have more slightly, someone who can qualify, a little bit higher paying job, maybe a little bit more responsibility. So a little easier to manage. And then the renovations so our strategy shifted more, just the renovations are more predictable. We're not going over crazy off budget. It's not taking forever on some things, not as big of surprises. So it's kind of shifted the risk down. The returns go down a bit, not drastically, because we're still doing pretty heavy value add and buying at discounts and, holding our cards till we find a good deal. So that's kind of been our philosophy. And then, just focused on Nashville and Chattanooga now instead of Memphis. It's got a lot, Memphis is great. It has its place as well. Still would invest there if you find the right deal. But I just like those markets a little bit better in terms of just job growth, wage growth, population growth, things like that.
Yeah, Chattanooga is a nice market. I went there years back with my wife, and it's very nice. It's a very nice area, definitely growing, and so one of those pockets that people don't speak about as much when they talk Tennessee. It's usually Nashville, and then I mean, people talk yeah, people don't really talk Memphis really. I mean, in my circles, I've been invited to invest in Memphis, and I've politely turned that down. But it's something that, yeah, for everybody. I mean, it's a place for everyone, right, in any type of market. So
Yeah, I've Chattanooga. It's been on my radar for 5 years. We're finally getting our first deal, and we've been over there a ton. Been rejected, not the first, getting the deal. So real excited about that market. And yeah, I think it's a great market. Kind of a little bit under the radar still, but I think it's going to get in that radar real soon.
yeah, that's great. The when you were talking about going back in the different kind of progression of your investing in multifamily, and I think most investors, especially the ones I speak to and myself, you start with a little C class stuff. Some people might even go lower, and then um, they're progressing to better properties, and you're taking risk off the table. It's better properties, better areas. You're getting into really a credit tenant type demographic. And I found, not that I wouldn't buy C class properties myself or with maybe one partner, but would I put it with investor money anymore? No. I think it raises risk, and I'd rather give lower returns that are more consistent, less volatile to investors than have hey, there's a upside, but then you have an older property most likely. So now there's a lot of unknowns during that. And what you were describing is almost like getting into more almost construction, where you have an asset that is so deferred. I mean, it's like you're literally rebuilding the property. So
Yes. Quite a bit. Yeah, that those are great points. And yeah, I see a lot of people kind of phasing from that. And and there's a place, and it's a great investment too, the C or the B. I mean, you make money everywhere. Just and also the time, right? You're just over there. There's a lot more updates. Also, we're not making, we're not doing any distributions, right? When you're 50% occupied till 2-3 years in, when it's finally getting stabilized. Where these other ones, we can do a little, 3, 4, 6% cash on cash just day one. It's already cash flowing. So there's the big risk part right there. Yeah, and yeah, the construction risk. Just you never know what these older houses have just been deferred, and it's hard to find in due diligence. You just will know when you get in there and open up a wall, right? Yeah.
So one of the things that your kind of team really, especially yourself, being an engineer, you guys utilize a lot of data when acquiring properties. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Can you kind of tell us what kind of data sources that you utilize and what you find is most important, and then possibly how investors, new investors, can utilize data without expensive subscriptions that usually come along with a lot of institutional investors that are utilizing very expensive subscriptions for sourcing data?
So I would just say CoStar. You got to get CoStar. I mean, on the properties we manage, Map, they're going there quarterly and doing a little survey, and they're like hitting the ground on every single property. So they're not just using like what's on the internet. They have survey employees all over the country getting the occupancy, the average rents and everything like quarterly. And so, I mean, it's just, yeah, you get what you pay for. The other data, so that's what I've learned. We tried for our first deal, but then after that, I just went straight CoStar. I mean, it has almost everything on there, of course, the county and all those records. So, I mean, my advice is try to split that with someone. So you could get someone who has the access, and they can download a lot of stuff for you, and you could work with them on that way. The brokers typically who list them will have that, and they can get you all that data too. You just need to know what's on there. But I mean, I just haven't found anything better, and that's why it's why it's there. And just once I mean, we were, we went to 100 units, right at the get go. I get if you're starting out with 5, 10, 20 unit things, like that cost isn't worth it. But man, when we started in the 100 units plus, it's like we got to have this, or is like buying blind, right? So I mean, that's my perspective. I didn't really look at too many others. That's just where I was at. So it's just one man's opinion.
What metrics did you find? Obviously, you're looking at rents, where the rents can go for a property. You're looking at job growth, population growth, all that type of stuff. Is there any other metrics that maybe are outside of the normal realm of what people should be looking at, no matter what their data source is?
Man, it's like, so I took a course, right, and it's so institutionalized and so cut straight. That's why I love real estate, right? This is like a business. Like, this is recurring revenue, right? It's a year-long lease, year-long recurring revenue. It's been around forever. There's data, there's sources, there's like years, hundreds of years of historical data out there, which is free on government websites. So yeah, I do use that, of course. And the brokers provide a lot of that too. It's just out there. So I mean, man, I just run everything, right? And one thing is, we made a custom, Gantt chart but more in terms of just the cost of renovating. Because, right, you buy 200 doors, they're 90% occupied. We kind of did that to kind of get a more accurate estimation of cash flow, how much reserves we need, upfront capex, basically to let us know like how much we need to raise, because you don't want to over raise, right? You don't want $1 million sitting in the operating account the entire time. You obviously don't want to be under, though, either. You do not want to do a capital call. So, more conservative. So as yet again, as I've had the historical deals on my previous 8 deals, we've now created that kind of more cash flow chart, which, I mean, that you really just got to grind it out and calculate it out over do a monthly projected cash flow for those first 2 years as you're heavily renovating these value adds that we're doing. So it's like, and you can work on that with your bookkeeper or yourself. I plugged it out myself because it was very important to us, because we almost had a capital call. We didn't, though, but we just had a second debt on it. But that's something to contingency and work for. And in real estate, everything's going to not go to plan anyway. So I mean, that's why it's hard. That's why not a lot of people do it. But that's also why it's very lucrative.
Yeah, there's a lot of things outside of your control, and just trying to navigate between everything. And if it's done, if you line it up correctly, and most of the time it's going to work out. And there's ways of alleviating some of that downside, but there's no way of getting rid of it entirely. So
right. And like experience, like there's the data, but man, your experience and your gut goes with. You're like, oh, this reminds me a lot of this other deal. It went like this. And this has the exact same thing, just so like experience, helps out a ton. And that's, my other partners have done other deals on their own. So we have like 2,000 doors plus experience, of just things, problems, good and bad things that have happened. And so now we know even more, like when we see a deal and all 3 of us are like, yes, on it, that just verifies even more. If one of us isn't, we really dig into why not, what's your feeling? Also, what's the data pointing to that, or the way it's been built, and things like that to help us know to pursue or not.
One thing I was looking at on your website was that you guys are real estate investors. You're also you guys also acquire different businesses. And can you go into this a little bit more in depth, because this is a little different from other people I've had in the show? Most of them are entirely real estate investors, and where they sway maybe is going between different asset classes. But tell us a little bit about the types of businesses that your firm focuses on purchasing, and kind of like what your business plan is typically after acquiring a business like that.
Yeah, so been doing flips and construction. So I like the trades, just seeing the bids they give me. So HVAC, plumbing, electrical, especially the ones that require licensing, there's a hurdle, there's a moat to get into that industry, and years to really go off on your own. So I'm under contract to purchase an HVAC, heating and air company. I just like it because out of all of the, home services, roofing, plumbing, electrical, sheetrock, fencing, landscaping, I like it because it has a recurring revenue aspect to it, right? You're going to biannually check up on those units, change the filters. And at that opportunity, it's a sales opportunity for a repair or replacement. And you're the go-to person to call. So you get a customer once, but they can be a lifetime customer. Where like those others, painting, right? Like they might not need another paint for a while. Where this has some recurring revenue on the service. So that's what I'm focusing on. Also anything that any of those businesses I mentioned though, I do like them. Anything repairing a house, services. So I'm pursuing those as well.
And those are pretty complementary to what you're doing too. So it's something that it's not that I'm a fan of or ever would probably think of buying a property management company, but it's different with the HVAC company because you can already say, I have this much work that's not going to go anywhere. You know what I mean? So that's a different way of approaching it than going, I guess, into, let's just say, left field and buying a business that has no connection whatsoever with what you're doing over here.
Exactly. I've heard a lot of the HVAC problems, and I've seen all the prices.
It's insane.
So
it's crazy.
yeah,
Definitely an industry with a lot of lack of people out there. And every time you call one, you don't call one and it's not busy. You know what I mean? Everyone is busy. And that's where they don't, you're like, how do they people stay in business? Well, they don't have to have that many people as, you know what I mean? It's
supply and demand. They can cherry pick, what they want. They literally have more work than their labor force can handle.
so, Sean, over the years of going from single family to multifamily, buying businesses, I mean, how has focus helped to you to scale your companies currently?
Yeah. So, I kind of engineer it out again. So, I write down, like, of course, any entrepreneur, I have just those wild thoughts, right? Those wild ideas. Oh, this could be a great revenue source. Could do coaching. We could do this, YouTube channel, podcast, right? And yeah, you gotta be aware. You have to be purposeful of what you're doing. You can't do it all, as you know, Charles. So, I just kind of quarterly and actually weekly, but quarterly definitely, real folks, but weekly I take a clarity break, just get on a piece of paper, write down the things, the easy low hanging fruits of ways to improve. And do those, right? So I kind of go, this thing, it'll take this much time, it's this much effort, it's this much importance. And then another column is just like, this is how much more revenue it can generate. This is the investment. And off of those factors, some are intrinsic, like value, money, right? Of course, the one that gives you the most money. But sometimes that's not the decision because there's ease and difficulty and what works for me. And, the self-awareness of what I'm good at and my skills and my partners and my team. So sometimes it's, this could be $1 million opportunity, but we might choose something that's just the $200,000 opportunity for growth. Because that's just aligning with me and my vision and what I want and enjoyment and difficulty and stress as well, right? There's the stress factor of just where you're at in your life, and it ebbs and flows, but so I guess just focusing on where you're at, what your capacity is now, where you want to go, and taking those baby steps, because there's the big step of where you want to go in the future. But kind of just breaking that down into weekly and quarterly action items, because it's thousands, tens of thousands of little tiny little steps to get up to that big goal. So you just focus on those weekly ones, and yeah, I give myself 3 to 10 to do things every week that are getting me towards that bigger goal. So I hope that kind of helps a little bbit with understanding. Is just, you got to have that awareness, and journaling. Something I've been getting into the past 3 years is journaling down those emotions and feelings, and your goals, your visions, your life. And I love it because I just toss that paper away. So then there's no judgment, right? You just get it and you just put it in the shredder. Of course, some you do have journal and you like keep them, right? But most of them I just throw them away, and it's just a good way for me to have that awareness, because us as entrepreneurs, we get a lot of stress, we get a lot of crap that comes at you, and you need that paper. That paper is that way to compartmentalize, get it out there. You've expressed it, you feel it, but then it doesn't affect you. It affects onto your team, your employees, your customers, right? You need to have that and process it. Because if you just hold it in and don't express it and have an outlet, you see it with tons of entrepreneurs, right? That they have an affair, get divorced, partnership breakup, make a bad decision. Not saying I'm free to everything, but I think it helps reduce those chances, and helps you just live a little more fulfilled and feel good.
Yeah, a lot of great information there. I had a mentor, and I think it was like 2018, tell me to start journaling. And it was something he's like, just start doing it weekly, and I've been doing it since. And it's great. It's great to put down things that you're thinking, what's going on, and when you look back on it, I mean, a lot of stuff you're dealing with, you kind of laugh at that was really stressing you out years before. And you're like, oh, yeah, yeah. So, I mean, it gives you, I think it builds a confidence muscle too, because you don't really, I mean, you don't look back at everything. And sometimes the stuff you look back at, maybe it's not the best, or those are tough times or whatever it is. You don't look back at all your maybe wins, you know what I mean? And charting those wins, no matter how small they are, I mean, gets you up for another day to fight as an entrepreneur, I think.
Yeah, and we do that with our teams quarterly and annually. Is we have a big whiteboard and what went well. Like, let's celebrate this. Wow, good job, Alex. Like, that was a great win. You landed that big client, or so and so, man, you got the renovation down from 110 days on average. You're at 90. Like, how'd you do that? That's amazing. Look at that shift. It's like and the data helps you too. Like, pinpoint who's doing well and like celebrate those wins on what's improving on our metrics and numbers. But then asking like why and how, and like like how can we emulate this? Like, nice work. And it's super fun to do that with your team. And then after you do that, then you dive into, all right, what's going wrong, everyone? Like, what are the problems? What can we improve? Right. But you gotta write those down.
So as we're kind of wrapping up here, I know we've gone over a few different things with kind of mistakes that it's been made before, and kind of real estate and business and how you see it. But what are common mistakes maybe that you see real estate investors make? I mean, you've been almost in this for several years now, and a lot of properties under your belt. What do you think are those big things that you see many real estate investors make, and or maybe you've made yourself?
Well, I mean, if you can look back, getting bridge debt with adjustable rate mortgages is probably like, I mean, right? That's what's killed a lot. Luckily, like we got out of ours before and refinanced into long term. I mean, but that's like something, like it's just so hard to know what's going on in 21 and 22, right? And that big change, 20-year, 40-year, just massive increase. But mistakes is they don't pay attention to this awareness stuff. They get way stressed and way high strung. They don't delegate to their team. They don't listen to their people and ask questions and get out of their way. They don't seek for self improvement, coaching or reading or listening to podcasts like this, and they get stuck in their little zone and just kind of in their box and fearful and missing out on great growth opportunities. And then, yeah, I mean, just a lot of those things I would say. And then just the big thing is just getting that culture is something, I mean, it's talked about a lot, but actually doing it takes a lot of effort, getting that team culture. And that really is when I'm reading on like, Marriott, Huntsman, Apple, all those guys, it's, yes, they had a great product, a great decision, but it would not have done even half as well without that, just the culture and energy and the I guess just the pure force of 1,000 lions that the whole team had just together of just wanting to accomplish something great. So that's where you go from a good manager, a good business owner to like an amazing leader. And you really change the lives of the people, because when you accomplish something, even if you're the bookkeeper on the team and it's a big company, like it drains into the other people, and I hope fulfills the lives of their kids, and they're happier when they go home and everything like that, and just improves the community. So entrepreneurs have a big control, whether they know or not, of just people's lives and their happiness and their satisfaction.
So, as we're kind of wrapping up here, what are the main factors contribute to your success over the years, both personally and professionally, from prior to getting in real estate, during your real estate career, and then also with other businesses that you're running in addition to your multifamily company?
Yeah, so a lot of people just come that are getting started, and they just have these, oh well, I don't have the money, I don't know how to do it. It's like, I didn't know a dang thing. I was in biomedical engineering. It's just, you just got to learn, talk to people. It's, you got to be courageous, and then also but learn and educate as quick as you can, and then implement what you're learning. And then I guess what I just talked about last question, just that's pretty much the same answer there, is that those culture and those other things I was talking about. So put a little bit of the previous question, that's kind of the same answer there too. And then I'd add just coaching mentorship, just helps you just get your thoughts again. And if you have a good coach, they question you, and it just helps you know where to go and what you're really seeking and how to solve the difficult problems you have ahead. And you really need support. You can't do it on your own. You need that support. You can't go as far as you'd want to at all. So be humble and seek advice and support.
A lot of great advice there, Sean. How can our listeners learn more about you and your business?
Yeah, so LinkedIn, Sean Tagge, hit me up. My website, acornea.com. That's acorn, ACORNEA, short for equity and acquisitions.com. That's why I'm kind of doing stuff. But yeah, you can hit me up there, and happy to help anyone out.
Well, thanks so much for coming on today. We'll put all those links down into the show notes, and looking forward to connecting with you here in the near future, Sean.
Yeah, thanks so much for having me on, Charles. I appreciate your insightful questions, and it was a pleasure.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.